Welcome, ladies and gentlemen, to Closing Bell. This is Fausto. How's everybody doing this wonderful Tuesday? It's 4:30 on, what is today? Today is July 8th, right? Wow, hopefully everybody had a wonderful 4th of July. I know we had off last week on Closing Bell, which I don't think we ever done that in probably 2 years. We had Robert Green. I know some of you would participate and have him on, but don't worry about it. He's going to be back the next month. But last Tuesday was an exclusive, day that we had to take off. The United States was playing in the Cup, and we obviously lost. So we didn't think a lot of people were going to be here. But we're back again, and we have our new presenter. We have a new channel partner. Actually, I know Dan Passarelli for a very, very long time. I would say probably it's got to be at least maybe 5 or 7 years. He's been around the block for a very, very long time, teaching options, also been on the CBOE floor, wrote 2 books of it. I've seen his books, read his books. I've read everyone's book, and I've learned a lot from it. So that's why we wanted him to come back and do a presentation. It's been a while since he's been here at CyberTrade University, but today's Closing Bell, remember, is a two-part event, and we have our very own Greg McDermott that's going to be doing options, who's a Philadelphia floor trader for options too. So you're going to get 2 great speakers going to talk about options today, and you're going to learn a lot from it. I always tell everybody, listen, options, a lot of people trade options for the wrong reason. And this is why you need to listen to professionals, why to trade options in the right way. Because I always find people trade option as the poor man playing a rich man's game. So if you listen, what I like, the reason why we're doing this presentation is to have a lot of you understand why to use options when you're supposed to use it and how to make money with it. And you're going to be learning from 2 floor traders. There's no one better to learn than from them to show you how to utilize it. So with that said, ladies and gentlemen, don't want to take too much from Dan. Everyone enjoy the presentation. If you have any questions, try to ask them at the end unless he asks for them, and try to keep your questions on the topic that he's covering. So without further ado, Dan, the stage is all yours.
I'm going to share my desktop in just a second, since I think I need to get the ball. But until then, thanks for having me, everyone. Welcome. And we have got some really great stuff to talk about here today. There we go. Perfect. Thank you, sir. Okay, let's share my screen here. There you go. Okay, we're going to talk about something very, very specific here today, and something very, very important here today. Trading for a lot of people lately has been a little tricky. It's harder to trade in low volatility environments. And that's evident by the fact that not only has it been low volatility lately, it's been low volume lately. Don't just trust me when I say that trading's been tough. I mean, there's fewer people trading, fewer contracts, fewer stocks, fewer everything. So what about you guys? You guys are here to watch this presentation. You're obviously traders. You're obviously trading. How do you expect to make money? So that's what we're going to talk about today, specifically how to trade in this low volatility environment. Now, before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Okay. Here's how it works with volatility in the options market. A lot of people get a little confused when we start talking about VIX and volatility, and that's because it's a little tricky. There's basically 2 different words, volatility. There's 2 different contexts of that word in the trading universe. And let's kind of clear that up right now and get everybody on the same page. When option traders talk about volatility, they're talking about one of 2 things: realized volatility or implied volatility. Realized volatility, that's kind of the easy one. It's basically a measure of how much the underlying stock has moved up or down lately. You know, when you see a chart that has really, really big price swings, That's a stock that has high realized volatility. When you see a real boring sideways trading stock, that's a stock with low realized volatility. Secondly, let's get a little tighter with our definition. This is the annualized standard deviation of a stock price. Okay, so what we're specifically doing is we're measuring the volatility, not just looking at a chart and saying, oh yeah, well this one looks volatile, oh yeah, well this one doesn't look volatile. Because it's sometimes it's kind of hard to tell which stock is more volatile than another one. Or is this stock more volatile than it used to be? If I just look at the stock chart, I can't tell that information. So I need to look at the annualized standard deviation. That gives me one solid number where I can say, oh, today the realized volatility is 42. Last week it was 30. So the stock is getting more volatile. The volatility of blah, blah, blah stock is 16, but the volatility of this other stock is 27, so this other stock is more volatile than blah, blah, blah. Realized volatility is also called historical volatility. Now, the tricky one here is implied volatility. That's a measure of how cheap or expensive options are. You may look at that and say, well, hold on a second. Volatility, what does that have to do with how cheap or expensive options are? I don't understand that. That just makes sense. Well, let me pose this question. What is the economic purpose of options? It's to hedge, right? If I own a stock, I can protect my stock with an insurance policy that is a put option. And when the market gets nervous and they fear that there's going to be heavy volatility, that's when people buy put options. And that forces the price of all options upwards, because all option prices are interrelated when they're on the same stock. So when the market expects future volatility, option prices go up. When the market expects volatility to fall, option prices go down. That's implied volatility. It's basically the future volatility implied by the market. Now, if you know how to use these two things, you can be an excellent option trader. Understanding just this one simple slide, this first slide I'm showing you, you understand that, you're going to be better than 90% of the traders out there. And I know that because I talk to them. I talk to hundreds of traders a week. I know what people know, I know what people don't know, and I know what the successful people are doing. And you know what they're doing? They're using realized and implied volatility. Now, the VIX is something that people are constantly talking about. You know, you can't go on Twitter without hearing somebody talking about the VIX. You can't read any business article without somebody talking about the VIX. The VIX is one of the most watched indexes in the market. And there's good reason for that. Let me explain what the VIX is. The VIX is the CBOE Volatility Index. And it measures a couple of things. It measures the implied volatility on the SPX. And that becomes really important. If you know what the VIX is, you may not know the implied volatility of every stock out there. But you've got a sense for what option prices are worth overall. It's just like, hey, maybe I'm thinking about trading Apple. But the first thing I do when I log into my computer is I say, okay, where's the market? What's the Dow Jones doing? What's the SPX doing? You know, S&P 500, what's that doing? Well, if you're an option trader, you do that, but you also say, all right, you know, I'm probably going to trade some Apple options, but let's see what the VIX is. Let's get a sense for if options are cheap or expensive right now. Now, I've got a couple of questions here. I'm going to take most of the questions at the end here, guys, and I'll stick around for a while and answer these questions. I think we go for, what, an hour? somebody correct me if I'm wrong here. Just really quick, somebody's saying, is there a difference between volatility and options in forex? Well, implied volatility is the volatility of options. So, just like that slide said. So, hopefully that answered your question. Another question says, what option trading platform do you recommend showing realized implied volatility? My platform only shows IV. Well, you can't really use that to trade options then. The one that I like a lot, I like a few. One that I like a lot, the one that I'm going to use in today's presentation is LiveVol. If you're interested, I got a guy over there. Send me an email, dan@markettaker.com, and I can have him give you a free demo of it. But any options-friendly broker is going to give you implied volatility, realized volatility, and charts of it, and obviously the Greeks. So there's a few different ways to define the VIX. The VIX is, by definition, the implied volatility of the SPX. Now, specifically, it's the implied volatility of a synthetically created 30-day option. Well, that may seem strange, but here's the thing. If you're going to look at the implied volatility, the implied volatility of a 29-day option could be different than a 30-day option, could be different than a 31-day option. So you need a 30-day option every day to compare apples to apples. Now, there's not a 30-day option on the SPX every day, right? Now they have weeklies, serial weeklies. So there's an option that expires every 7 days or so. There's options that expire at the end of the quarter, and then, of course, there's regular expiration options, the third Friday of every month, basically. But those other days when there's not a 30-day option, they need to create one. So they take options that expire just less than 30 days, options that expire just more than 30 days, and they sort of weigh them. They use in the money, at the money, and out of the money, calls and puts to kind of give a feel for exactly what the price of the implied volatility is. It's reasonably accurate. There's a little trickiness. There's a little sort of what I might refer to as pricing voodoo there, but it's a benchmark that's constant every day, so it's a great apples-to-apples comparison. Another way, let's see here, Boba Fett says, I see different VIX indicators. Does it matter? Well, there's one VIX, but then there's like VXX, which is an ETF listed on the VIX. There's, VXN, which is the implied volatility of the NASDAQ. There's lots of different volatility indicators, but the VIX is the VIX. Now, Dow Jones media companies like Barron's and Wall Street Journals back in the day called the VIX the fear gauge in their articles. They still do. Wall Street Journal and Barron's still use the term fear gauge. That implies that the VIX rises when the market is scared because investors buy up options to hedge. And there's something to that. In fact, one of the things you see is that when the market falls, volatility tends to go up. The implied volatility tends to rise, and vice versa. When the market goes up, implied volatility tends to fall. Now, to some people, this mistakenly implies that the VIX is a leading indicator, which it is not. It's typically, you have to know which is the dog and which is the tail here. Typically, the market goes down, and then volatility goes up as options hedgers react. So, you can't really use the VIX as a leading indicator to figure out direction of where the underlying stock is going. And even if you could, it's still predicated on the traders, investors who are using options to hedge, that they're going to be correct. And plenty of times they're not. Plenty of times we see there's a big trade that goes up in the calls, and what happens? The stock falls. People also refer to volatility, and the VIX specifically, as the estimate for the market's future volatility. That is sort of a fallacy as well. Yes, it is true that, when the market gets scared, there's enough players out there who are going in and buying options to hedge that it forces implied volatility up. And when the market is really, really boring and volumes are low and the thing just does nothing but slowly grind higher, then nobody's scared. And so implied volatility falls because everybody's selling covered calls, selling, cash secured puts and put spreads, doing other forms of income trades. And you look at the VIX, right now it's very, very low, which we're going to take a very close look at in a second. There is definitely an obvious correlation between the market's estimate for future volatility and where the implied volatility or the VIX is. But there's plenty of noise there. There's plenty of people who are out there trading options who are beginners and don't use volatility, and they're just kind of guessing on direction. Fausto in the introduction said that a lot of people misuse options, and he's right on the money. People say, oh, well, I heard that, I can use calls instead of buying the stock, and I can't afford to buy Priceline stock, so I'm just going to buy some Priceline calls. Like Fausto said, poor man's, stock trading for poor people, I guess, paraphrasing. That is a total misuse of options, and those people tend to lose money in the long run. Why? Because option pricing is rooted in this, in exactly what we're talking about, in volatility. The guys who make money and the girls who make money trading options, they're trading a little bit more sophisticated than that simple stock substitute concept. They're using volatility to get an edge on their option trades, and they only buy it when it's cheap, and they only sell it when it's expensive. So along those lines, right now, if we look at the VIX, and in just a couple of seconds, we're going to take a look at some trades. I'll even entertain some trades from you guys, but I've got a couple trade ideas that I'd like to share with you. But until then, let's talk about what's going on right now in the market with the VIX. Right now, the VIX is oppressively low. And in the last couple of days, it ticked up a little bit with the market coming down, but the VIX is near all-time lows. That implies somewhat complacency. And I don't think, I've been in the options business for 20 years. I traded down on the floor of the CBOE. I've been actively involved in the options market for almost half the years I've been alive. And I have gray hair. I have never seen a more complacent market, ever. That's why the VIX is so low. Options are incredibly cheap right now. However, I can show you many scenarios where even though options are at low depressed prices, they're still too expensive for where they should be, and they're perfect for doing some basic level income trading, like credit spreads, for example. So here's what we're going to do. There we go. We're going to look at a few trades here. When I look at trades, what I do is I like to start out looking at the stock chart. That's basically your base level start of your analysis. This is Apple stock. We all know what happened with Apple stock a few weeks ago. It split 7-to-1, correct? And Since then, it had a little bit of a pullback. A lot of people were expecting the stock to go up, but the stock faded those pundits. And you know what? It's been climbing back, and look where we are now. Not quite at all-time highs, but at 6-month highs, at 1-year highs. And a lot of stocks, especially Apple. Apple is a very, very unique stock. Apple's a unique stock. It's been called America's stock because you know what? Most of the trading volume in Apple is retail traders, regular Joes. Not the institutional guys, not the professionals at Goldman Sachs, but regular people. And so, because of that, to be fair, it's kind of the amateurs that are trading it in a lot of cases. I mean, some of you guys might trade it, and you're beyond amateurs, but there's a lot of amateurs out there who are trading. And so, there's some interesting anomalies when it comes to Apple stock. One being, for a very long time, the volatility strike skew was backwards on Apple. The calls had higher implied volatility than the put. The higher the call strike, the more expensive they were. That's opposite of how things usually are. Another thing is the par level. You know, like that psychological $100 price tag, or back before it split, the $500, $600, $700, $800 price tag was a very, very significant psychological level. It would act as support or resistance, and it could even draw the stock to it or away from it. Right now in Apple, you know what the single most important price tag is here? $100 a share. That's what people are looking for the stock to go to. $100 a share. So you know what? I'm looking for a way to play that. Anybody have any ideas on how to play Apple going to 100? There's some obvious ideas, but you know what? The obvious ideas are not the good ones. The obvious idea is, well, I'm just going to buy some calls. But you wouldn't want to buy calls because, look, the implied volatility, that's this red line, it's up near the top half of its 6-month range, and it's way above historical volatility. Options are extremely expensive in Apple right now. You're paying overpriced when you buy options in Apple right now, way overpriced. Now, a lot of people don't look at the implied volatility, but the implied volatility is really the price tag of options. It's like going into a car dealership and saying, hey, show me this Ford Focus over here. I heard those are pretty good cars. I want to buy one. And the car dealer says, okay, well, that'll be $200,000. And you say, okay, where do I sign? You don't just go and buy without figuring out what the price should be when you buy a car, when you buy groceries, when you buy airline tickets. As a consumer, you look at what the value should be, and if you get a good deal, you buy it. But there's a lot of amateur option traders out there who don't do that. They just say, oh, well, I can buy these calls for $3. I guess that's what they're worth. I'll buy them. I hope the stock goes up. And a lot of times the stock goes up, but the volatility falls so much that they still lose money even though they were right. You got to look at the volatility. So you can't buy calls. Now I've got a couple of people saying sell puts, but if you really want to sell naked puts on a stock like this, with the market overall at like pretty much all-time highs, there's a lot of people who are professionals who are whispering about a potential coming correction. You really want to sell naked puts to try and squeeze out 75 cents on a put and risk losing thousands and thousands of dollars? Somebody says a bull put spread. I like you, Mark. Bull put spread indeed. Boba says credit spread too. I assume you're saying credit put spread. That's better. You have limited risk then. But you know, you can still lose more than you can make. Now, don't get me wrong. I'm definitely not opposed to credit spread. I would probably say most of the trades I trade are credit spreads. But I'm just, kind of thinking out of the box here. I'm thinking that maybe we could even do a little bit better than a credit spread here. What if we did this? What if we looked at the regular July expiration, which is the 19th, I think, right? Butterfly, regular butterfly. No, we still need more strikes here. Butterflies people don't think about butterflies as being directional trades, but they can be huge directional trades. Oops. What if I bought the July 97.14 calls, sold the 100 calls twice, and then bought the 102.86 strike calls? How about that butterfly? I pay barely anything for it. I pay 40 cents, and my risk on that is, let's see, is 40 cents, but my maximum profit is $2.46. So I can make 6 times my money if it works out. And if at July expiration, Apple's trading close to $100, I can make about 6 times my money. And I'm risking comparatively barely anything. Why do I select a butterfly? Well, I mean, obviously, because my risk reward is superior to any trade out there. Butterflies work great with short time horizons, less than 2 weeks until expiration. They work great when the implied volatility is jacked up like it is here. Ralph says, tell me again what butterfly? The July 97.14, 100, 102.86 call butterfly. This is a directional butterfly, which is a little different than people typically use them. A lot of people do them as direction neutral trades, income trades. If you know how to read the charts, you know what the charts are telling you, including volatility charts, you can structure some highly superior trades. And by the way, I just want to confirm with the host here, I'm going till 5:15 or 5:30, if you don't mind. All right. So let's look at another trade example here. Amazon. Let's take a little look, see what's going on in Amazon. So what do we have here? We've got the stock hasn't crossed below 320 for a while now. Since the beginning of June, and it's got more support down at 315. And look at here. The implied volatility here is high as well. This is a fascinating market to trade because you can find some mispriced option opportunities that give you a tremendous advantage if you know where and how to look for them. Right now, everybody says, oh yeah, volatility is so low, and it is. But when you find opportunities like we found here in Apple and then Amazon, even though volatility is low across the board, it's overly expensive here. It's too high. So this gives us a great opportunity for selling. And because we've got support under the market, the opportunities for some put credit spreads. A good one here is we could keep this nice and short expiration. The regular July 310, 315 put spread. So sell the July 315 puts at 242, buy the July 310 puts at 153. So let's just call that 90 cents. We've got a bunch of support at 20. We've got a bunch of support at 15. Stock hasn't been below 320 for a long, long time, and the put spread is too expensive. We're getting overpaid for selling that. And the stock would have to fall almost $19 in 11 days. It could happen, but it's less likely than not. So there, like I said, you know how to read the charts, and including volatility charts. As an option trader, you can set up some super high probability trades with awesome risk reward. Now, we're going to talk about a couple more trade ideas I have, and I'm even going to take some Q&A from you, and you can suggest some trades, and I can analyze them for you here live. But I want to talk about a little deal that I have for you guys. This is my deal of the day. Every month I do a 4-part class. Here in August, this class starts in 2 days on Thursday. I'm doing 4 classes on technical analysis for option traders. We actually have a special guest presenter, Dave Rogers, who's been in the options business for 25 years. He traded on the floor of the Philly. He traded on the floor of the SIBO. He traded on the floor of the CME group, I think it was. SIBO and the CME group, those are the 2 largest options exchanges in the world. He was a big, huge, successful trader. He's going to show you his techniques for using technical analysis to trade options. This is one of the best classes we've ever had. The first class is point and figure charting. That's a rare trade. That is like real insider stuff. Then trading candles and common indicators, optimal option strategies for breakouts and trends, and profiting on consolidation and neutral trends, which we've seen a ton of lately. You're going to get those 4 live classes. They're presented on those Thursdays at 3:30 Central Time, this time of day. Plus, here's the best part. You're going to get 6 months of archived seminars, including the 4-part series we did on volatility in the options market, like what we're talking about here. The 4-part series on protecting your options portfolio. 4-part series on trade execution and beating the market maker. And then mastering time spreads and a whole lot more. This is basically 24 classes. Each are an hour and 15 minutes long. And plus you're going to get all this bonus stuff, our events calendar, trading journal, trading path, online tutorials, and more. You're basically getting about a 35-hour class. Imagine what you would pay for a 35-hour class. I've seen these classes listed online and such for thousands of dollars, 35. I've seen a 1-day 8-hour class listed for a couple $1,000 bucks. You're not going to believe the value you're going to get. Normal price, I give this away for $2.99. I mean, that's your profit on 1 trade. But today, you're getting 50 bucks off. This is limited, however. I advertised this to my people earlier. I'm only taking the first 20 people, and I've had some people sign up for this today. Only the first 20 people get 50 bucks off. 1, 2, 3, go. MarketTaker.com/op-ed. Use the coupon code 50OFF, 50OFF. If you're among the first 20 people to use that promo code, it's going to work for you. After that, you pay the full $299, but for gosh sake, that's still a steal at that price. Does anybody have any questions about this class before I go back to the charts and talk about some trades we have on here? Sam says, well, why do we need the archives of the class? Things aren't going to be the same in the future, of course. But these classes, guys, these classes are at 9 o'clock Central Time. That's 10 Eastern Time, a half hour after the market opens. And, you know, some people work and they can't make the live classes, so they look at the recorded classes. Oh, excuse me. No, I'm sorry. These classes are at 3:30 Central Time, a half hour after the market opens this time of day. These classes are not about trade ideas. They're teaching you the tools you need to be a better trader. So these archives you want to look at. They're not like, you know, hey, here's a trade idea, go trade this now. This is, here, let me show you how volatility works. Let me show you this chart setup, so when you see this chart setup, you can go. This is designed to make you the trader, give you the knowledge you need to succeed. So yeah, Sam, the archives of this class are the most important part of it. You are dying for those archives, especially for 250 bucks. 250 bucks, of course, for the first 20 people, although, like I said, I did have a few people sign up for this earlier today, so I know there's not 20 spots left. And you know what? I'll tell you what. For the first 5 people who sign up right now, I'm also going to throw in one-on-one coaching session with you. We're going to sit down, and it's going to be just me and you on a private webinar just for you. But it's not just me talking and you typing in questions. We're going to be able to talk to each other over the computer, voice over IP. And we're going to look at your trading account, real trades you have on in your account. And we're going to give you adjustment strategies for those. We're going to talk about how to set it up, how to repair a trade that maybe went against you. I sell my one-on-one coaching for about $500 an hour. The first 5 people who sign up for this $250 class, you're going to get that $500 value for free. But frankly, I think you're going to have to be quick. Catherine says, so classes are recorded and posted. Yeah, like I present them live on every Thursday. The rest of the Thursdays of this month, you're going to get the live class at 3:30 Central Time. And it's just like this. There's a PowerPoint. You can log in. You can ask questions. But then they're also recorded. So if you want to review what you missed, yeah, then you get that recording of it as well. Do we have any more questions specifically about this class? And again, yes, it is only the first 5 people who enroll in this. And in order to do that, it's pretty simple and straightforward. markettaker.com/oped, OPED. And for those of you, you know, I'm giving you about 35 hours of class for less than $300. It's practically giving it away, you know. What a lot of people do is they stick around month after month after month, because you'll get a new 4-part series next month, which I think is going to be on option adjustments. So some people stick around month after month, and if you decide to stay in the class, it's $299 every month. You get $50 off your first month for trying it out, and you don't have to stick around for past the first month. If you do, it's just another $299, but you sure don't have to. Here's what usually happens. People sign up and say, well, I'm just gonna sign up, you know, pay this discount price and just learn as much as I can in a month, and then, you know, just drop out. And that's fine. I sure don't have a problem with that. But I bet you won't. I bet you'll want to stick around, because there's so much knowledge in each one of these classes that you'll probably want to review them, go over them over and over again, and attend the live classes. Arvid says, how long will I be able to access the videos? for as long as you're in the class. So if you sign up for this first month, you'll get a username and password today, and you'll be able to use that for the next 30 days. If you decide to stay in for another month, then you pay $2.99, and you stay in for another month. You get to access those videos for another month. It's, as far as value goes, it's a tremendous, tremendous value. Okay, is that it, everyone? And, oh, thank you. They just posted, you know what? Okay, they just posted for me. Thank you, guys. The link, so all you have to do is click on that link right there. You don't even have to type anything into your computer except your information so that we can get you set up with the class, which I will hope to do today. You will hear from Amy at Market Taker probably within the next hour. Worst case scenario, tomorrow morning. That's fine. The first live class is Thursday at 3:30 Central Time. Use that coupon code 50OFF. Don't forget to use that. I mean, that takes an incredible deal to just a plain sick deal. Just awesome. All right. And question here is, what other classes will we have access to? So, like I said, every month there's a different theme. This month is all technical analysis for option traders. But some of the past classes were things like, here, let me pull it up. Volatility in the options market. That is essential. That shows you how to get edge on all your trades. There was also mastering income trading. What else is there? Oh, no, mastering time spreads. Here it is. There is protecting your options portfolio. Hedging tactics portfolio-wide to limit your risk in the event of a market correction, like some people are talking about potentially happening. Trade execution and beating the market maker. I used to be a market maker. I know all the tips and tricks. I know where you fight the market maker and how you can beat them. And I also know a lot of scenarios where the market maker is actually your friend and how he can help you. I'll give you the inside story on that. I teach that class myself. Then there's how Dan Passarelli trades options. I'll walk you step by step through my trading methodology. So this is, you know, the Market Taker online education series that we're talking about here. It's one of our most popular classes, and for good reason. You know, you want to learn about options and you're willing to spend hours just filling your head like a sponge with all the information you need. Guess what, guys? You're going to get it. And you're going to get it at a steal. I mean, the fact of the matter is, $250. You have one winning trade. It could be a two-lot winning trade. And that would cover the cost of the class, wouldn't it? So, you know, this is just something. Welcome to the Market Taker family. Here's a great value, and I think you're going to be a student of ours for a long, long, long time. And like I said, all of you guys, you know what? I've probably had more than 5 people sign up for. Here's what I'm going to do. Anybody who's watching this live, if there's a recording and you're watching this on a recording, you don't get this. If you're watching this live, anybody who signs up right now, not just the first 5, you're going to get a free one-on-one coaching session with me. The one-on-one coaching session, like I said, you know, I sell that for $500. You're going to get that free for paying $250, plus 35 hours of class time, recorded and some of it live. Okay. Let's, I think I've still got 10 minutes. I haven't seen a big cane come into the audience here yet, so I imagine they're not pulling me off stage just yet. Let me get back to my PowerPoint here. Oh, I am back to my PowerPoint here. No, I need to get back to live vols that I need to do. Okay, I have got another trade here for you. Now let me just go back to my notes. CSCO. This is Cisco Systems. Look, the stock finally closed consecutively over 25 bucks. After encountering resistance at that level, it tried and tried and tried to establish itself above the $25 resistance level. But I think I can. It finally made it. The weekly chart shows a nice breakout on a bullish face. These are the daily candles. There is room to move to 26 bucks. You know, this is not a big mover. 26 bucks is 4%. And you know what? Once this stock establishes itself above a resistance level, that level becomes support. Now, here's what I'm looking at. We could do one of a couple of things here. I would look at this being a somewhat short-term trade. So let's look at this. Let's look at the July level. Now, normally, yeah, Greg's asking, I was going to ask, in some cases, the IV doesn't really matter because you buy inflated vol, you're also selling inflated vol to close. Well, it doesn't matter if you're selling it to close. If you buy a call now, if it's not part of a spread, you're just buying implied volatility, which could fall tomorrow, and you could lose money on implied volatility. It's called your vega risk. So, you know, unless it's part of a spread, it doesn't matter if you're hoping to close it later at inflated vol, even if it is only like a 2 trading day or something like that. You don't want that volatility risk, that vega risk. Now, stock like Cisco here, the volatility is somewhat high. It's not sky high. Normally, I would do a spread, but look at this. For spreads, you sell the short strike at the target where you think the stock could get up to. I think the stock could get up to 26. So what I would normally do, and I'm not going to do this here, but normally I would say, well, I want to buy an expensive option and then sell an expensive option. So I'd buy the 25 calls, sell the 26 calls, but guess what? The 26 calls are too cheap to sell. I can only get 3 cents for them. And the 25 calls, even though the volatility is somewhat high, it's still only a 14.7 volatility. So these calls are 29 measly cents. So I don't have to do a spread here. I can just sit there and buy the 25 calls, keep it a nice short-term trade. It's easier to get out of that because there's no legging. There's not 2 different legs to worry about. So that one, you know, there's another lesson for trading in these low volatility environments. You know, volatility, just nominally, it's so cheap, below 15 on an equity, that I can just go and buy a call here in this specific case and not a spread, because I don't have to worry about spreading it because it's so gosh darn inexpensive. And this is the kind of stuff, like that class that we were talking about. Hold on a second. Where'd it go? That class that I was talking about here, optimal option strategies for breakouts and trends, that's what we're talking about right here. You know, I mean, some people would screw that up. Some people would say, hey, you know what, I think the volatility is high, I'm going to trade a spread. And they trade a spread like this, selling the one option for 3 cents, not worth it, limit your profit potential for no reason. You know, selecting the best strategy for the market scenario, that's your key to success. I mean, any bozo can go buy a call. But in the scenario of the Apple stock, you would never buy a call on Apple. You'd be crazy to. Too expensive. You could sell a put spread that's better. Do the butterfly. That's for the win right there, man. So, you know, one whole class out of this 4-hour class is devoted for selecting the best strategy. Oh yeah, question, when is the, so it's here, markettaker.com/OPED, coupon code 50OFF. I'll tell you what, guys, truth be told, just for that 1 hour and 15-minute class, because each of those 4 classes is an hour and 15 minutes. Just that one class alone is worth paying $250 for. But you're going to get all those classes, plus 24 more classes from the past 6 months of 4-part series, all on video, archived, ready for you to go, plus a free one-on-one coaching session with me personally, where we're going to go over real trades that you have on in your account that are maybe giving you trouble, and maybe you're down money. Maybe you put on some, you know, whatever, spread on in Netflix, and it's totally gone against you. You're down a bunch of money. You're saying, geez, what am I going to do? Well, there might be an adjustment strategy. One of the main things we teach here is adjustment strategies to take losing trades and potentially turn them into winning trades. It's essential. Otherwise, you're just, you know. Okay, so Joe says, Dan, I signed up. How do I get the one-on-one consultation? Here's what I'm going to do. Joe, you're going to get a couple emails over the next 24 hours. One is going to be a username and password. So you can log in and start watching those archive classes right away. Tons of learning there. Then you're going to get an invite to our class to be held on Thursday, the live class. Obviously, if you can't make it, it'll be recorded. You just watch it later. But try and make it live so you can ask questions. And we're also going to ask you for 3 time slots over the next couple weeks as to when you want to do your 1-hour online one-on-one coaching session. So we're just going to ask you, it's just going to be done via email. You're going to email me. I'm going to see when I'm available. And, you know, I'll just pick one of the times that you pick, and we're going to do it. You're going to love that. Like I said, I sell that for $500. You're getting it free for buying a $250 class. Okay. Next. Where do we leave off? Does anybody have a stock that they'd like to have me sort of analyze here? I could maybe squeeze in one more. I don't want to overstay my welcome here, guys. If you want, give me like a 1-minute warning. I'll wrap it up. I definitely don't want to run over because I think you guys have something after me. Jim's the winner. Let's look at our friend Tesla. Tesla. Oops, that's not it. All right, so take a look at Tesla and tell me what you see here. Look, stocks, it's kind of a funny chart here. Tesla's an interesting one, isn't it? It's been kind of grinding higher, but not in a normal oscillating fashion, you know, like back here, you know, we've had higher lows and higher highs. This is like a normal grind higher. This is sort of a strange one. You know, the 50-day moving average here acted as a support level. We had a big shoot up here, the 50-day moving average, again, looking like it's going to be a support level. We don't have earnings until August 6th, so I'm not dreadfully concerned there. We've got some support here at about this 217 level. We're sitting here right at support. This doji is not extremely bullish, but it's somewhat bullish. Implied volatility really quick. Yeah, this is a little inconclusive as well. It's above historical, which is one indication that it's somewhat expensive, but it's not, it's kind of inconclusive relative to itself. we might be able to cobble together a put spread, which I would trade very small put credit spread. It's not a perfect put credit spread candidate, but it's okay. I would look at something ideally short term. The support was at about 216. Joe says, I use TradeStation as my platform. Can you work with that for the one-on-one? Absolutely. Yeah. I love the guys over at TradeStation. Good platform as well. So the support's at about 216, so I have to sell a put strike. My short strike's got to be below there. I give myself a little more wiggle room to sell the 210 strike. So maybe sell the 210 puts by the 205 puts, which I can do for about $1.10. That's a great premium. There's a nice spread for you. It's an 11-day trade selling the July 19th expiration 205 210 put spread for $1.10. Can't go wrong with that. All right. Hey, guys, I'm going to leave because, like I said, I don't want to overstay my welcome here. One last time, get this 4-hour class. This is a no-brainer. MarketTaker.com/op-ed. If you're going to take one of my classes, this is a great one to start with because it's incredible value. And we've got Dave Rogers here, who's incredible. Everyone, thank you for having me. If you have any questions, you can email me, dan@markettaker.com. Somebody said they had a question about LiveVol. I don't work for LiveVol, but I like them a lot, and I've got a guy over there. Email me, dan@markettaker.com, and I can just hook you up with my guy if you'd like. All right, everyone. Have a great day and trade smart. And to all the folks, Fausto and everybody, thanks you very much for having me. I really appreciate it. Thank you.
Good afternoon, everybody. Greg McDermott with Cyber Trading University checking in. Once again, find myself in the unenviable position